shockwave from the US rattles global tech, the truth behind the storage chip crash. Last night, global technology and capital markets were gripped by a sudden, severe sell-off. This was no ordinary market correction. It was a systemic storm, triggered by a plunge in storage chip giant SanDisk, which fell over 20% in a single day, and followed by peers like Micron and Western Digital. Like a depth charge, this drop sent powerful ripples through a tech stock pond already overheated by AI mania. This isn't just about a few companies' stock prices. It's a mirror, starkly reflecting the deep fissures and structural conflicts within the global semiconductor industry, especially in storage chips, that have been masked by a facade of prosperity. First, we must dispel a common illusion. Many are blaming the crash on market sentiment or shifting narratives about Fed rate cuts. While these provide background noise, they are not the main story. The real trigger is a brutal, AI-driven battle for resources within the storage industry. AI servers, the much-hyped future, are causing exponential growth in demand for high-bandwidth memory, HBM. To fight for this highly profitable market, giants like Samsung and SK Hynix are diverting over 60% of their new capacity, and even some existing production lines, to making HBM. What does this mean? It means the supply of conventional DRAM and NAND flash chips for phones and PCs is being ruthlessly squeezed. An absurd yet real situation has emerged. On one side, prices for AI-related HBM are soaring, with contract prices up over 50% year-on-year. On the other, consumer electronics manufacturers are grappling with relentlessly rising storage costs. Adding to the irony, server makers can pay over 30% more for the same chips than phone makers, thanks to their higher pricing power. This massive profit gap further encourages chip makers to favor the lucrative AI sector. SanDisk's tragedy is that it's caught in the eye of this storm, trying to capitalize on the AI boom while still being dragged down by its exposure to the consumer market. Its earnings revealed revenue growth but gross margins far below expectations. A sky-high PE ratio of 765 made it a perfect target for short sellers. When an industry's valuation is built on a sand dune of optimistic future expectations, even the slightest breeze of reality can trigger an avalanche. The impact on China's A-shares, more than just panic. The fallout from this US-ignited storm on China's A-shares will be far more profound and complex than simple contagion. The most immediate effect will be the spread of panic. Yesterday's US massacre will inevitably pressure A-share storage stocks like Jiangbelong and GigaDevice at the open. But that's just the surface. The deeper impact is that it forces us to re-examine the reality of China's domestic substitution narrative. On one hand, the landscape is fraught with risk. Many A-share storage firms are still focused on the consumer electronics sector. As global giants reduce investment in this market and face volatile raw material costs. Subscribe for the full, in-depth analysis on what comes next.